loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. Hey everyone, I'm Roger Herring. I am the Investor's Accountant. It is great to be with you here today for another edition of Ask Roger. You get to ask me a question about real estate taxes, wealth building, all those wonderful things that we love to talk about here. We even love to really talk about how to operate in tax-free environments. Today, I got a question from a gentleman that was emailed to me. He wants to know why he can't write off his rental property. This is from David. It says, I bought my first rental last year. I did a full rehab, had it in service by the last day of the year. I even did a cost segregation. Now my CPA tells me I don't qualify to be able to write it off. What gives? Well, David, it could be any number of things. But the reality is not everybody can write off their rental losses. There are three specific ways that this works. Okay, here they are. The first way you can write off rental losses is to have passive income, because passive loss can offset passive income. Now, Roger, I don't want to lose money. This is a created loss. We create this loss with depreciation and tactics like cost segregation that David mentioned. Okay, so passive income can be offset by passive loss. Where does passive income come from? Well, that could be taxable income coming off of another rental. It could be passive income from being a shareholder in an S corporation, or from being a partner, a limited partner in a partnership. Passive means you have less than 500 hours of activity in each of those businesses. Okay, that's way one. Way two is to be full-time real estate, to be what's called a real estate pro. So here are the requirements. First off, there's nothing to do with license. It's all about time. Okay, rule one, 750 hours minimum. That's easy because you get to do it across rental properties, being a broker, being a landlord, being a flipper, being a wholesaler, and a few others that are there, but that's the most common ones that we've got. Okay, and you have to be an owner. You can't be somebody else's employee for this. This has to be your business, your activity. That's easy, 750 hours. The second one may not be so easy. Second requirement says more than half of your for-profit time must be spent in must be spent in real estate. Any of those professions that we just called out, okay, 750 hours and more than half of your for-profit time. Okay. Third thing, you got to have material participation on the rental activity. What does that mean? Material participation means that you have to physically work on the properties for a specific amount of time. Now, there are 7 different ways to prove material participation. The most common one is to have an election to treat all of your rentals as a single business activity, and you have 500 hours across all of them. Another way is to have 100 hours per property, and nobody else has more time than you do. So whatever your situation is, that works. Now, once you qualify for being a pro, what do you get? No limits. Absolutely no limits on deductibility. You can create a loss of $200,000 and write it off against your other income. No questions asked. Okay, but you got to have a time log and you got to be able to prove it. All right, so that's the second way. Well, Roger, I don't have any passive income and I don't qualify because I have a full-time job. So what's left for me? Well, you may be able to take the losses as an active participant. Now, you can't take them all, but you could take up to $25,000 in a single year. That's better than nothing. So here's how this works. You got to be making the decisions. You can have a property manager, but you're the one that has to make the decisions. You may swing the hammer,
turn the screwdriver, work on the property, deal with the tenants, whatever, or you could be making decisions and having a property manager pick up your rents and answer the phone at 2 in the morning when the plumbing goes out. All right. Those are your options until, okay, that 25,000 is good until you plus your spouse, if you're married, have an adjusted gross income of 100 grand. Then you go into phase out, and for every dollar over 100K, you lose 50 cents of that 25K, that deduction. So at $150,000, you can't take anything in the current year. So Roger, what does that mean? Holding rental property, if I can't take deductions, is not a good idea. Not what I said at all. Because the first thing is you never lose those deductions. Because another thing that's going to create passive income is when you sell one of those rental properties. That will create passive income. And now we can go back and recapture all of those losses and apply it against that income. That's good. And those losses never go away. But the real thing that you are after is tax-free cash flow. Because if you're renting something for $2,000 a month and off that $2,000, you have $500 positive cash flow, but we also are able to take depreciation of over $500 a month. We have just brought our income on paper to zero, yet we're getting $500 a month times 12 months totally tax-free. It's all about cash flow, guys. That's the game. Plus, you know where else cash flow comes from? Cash out refi. Think about it. I hope you have enjoyed today. If you want to get in on one of the questions, shoot me an email, reach out to me on Facebook, or just comment right down below. Till the next time, Roger out.